Welcome to this week's current federal tax developments for the week of January the 29th, 2018. Current federal tax developments are brought to you by your state society of CPAs and Kaplan Professional Education. This week, we're going to discover that the IRS employees and various people from Treasury became a bit more talkative. And there have been a number of articles published this week by tax analysts. And we'll talk about some of what's been reported there because some of this is useful information to understand for how the IRS is going to approach the Tax Cuts and Jobs Act. We'll also take a look at a new form that has been issued if you want a termination letter for a 501c4 organization. Finally, we'll take a look at a taxpayer who came up with a unique way of trying to file his tax return. A unique but not very effective way of doing so. Let's start out with a discussion of an issue that is going to be significant. As I said, this week we had a lot of IRS and Treasury employees talking to various organizations, and especially at a District of Columbia Bar Community of Taxation set of events that came up this week. And the first thing we're going to talk about here is an issue that a lot of us have been wondering about ever since the Tax Cuts and Jobs Act was passed. If you remember, under the Tax Cuts and Jobs Act, we have changed what we're going to use for computing inflation adjustments for tax items, or at least for most of them. We're going to go from the standard CPI, what most people consider to be the Standard Consumer Price Index, which is formally called the CPI-U, to what's referred to as the chained CPI, which is the CCPI-U. Now, the chained CPI is a consumer price index, but where it is assumed that in reaction to higher prices, there's going to be some effect on consumers that instead of buying the more expensive, the item that now has gone up in price, they will ratchet down maybe and substitute a less expensive item. So, for instance, using something from the tech world that did get a lot of press this past year, maybe you had always bought yourself a high-end, the highest-end Apple iPhone. Whenever a new iPhone came out, you bought a brand, you bought the newest and, the greatest and most wonderful model. Well, this past year, as you're aware, Apple came out with the iPhone X, the iPhone 10, and the iPhone 10 was a lot more expensive than it had been in the past, right? The price went up dramatically. So what the chain consumer price index would look at, and this isn't really an example of what's in the basket, but we'll still use it for this point. Instead of buying an iPhone 10, you might have decided that I will instead buy, they introduced a less expensive, not exactly inexpensive, but less expensive phone, the iPhone 8, the iPhone 8 Plus. So instead of buying an iPhone 10, I'll save a couple $100 and buy an iPhone 8 Plus. And maybe, also I could have saved money that rather than going for that, the highest capacity iPhone, I might have gone for the lower capacity iPhone. So the chain CPI would look at it that way, that there are some moves you'll make. Instead of having filet mignon, you might go to McDonald's. Okay, that's kind of extreme. But nevertheless, you would adjust your spending habits. What this has the effect of doing is lowering the rate of inflation. When you compute change CPI, the inflation rate goes down. When the inflation rate goes down, the tax numbers that are based on, change based on that rate would go down. Our concern became that, according to the law, it was effective for 2018. So it'd be tax years beginning after 2017. Why is that a problem? Because back in October, the IRS published a whole bunch of numbers that are to have been, and that people began planning, assuming, are the 2018 inflation-adjusted numbers. And this affects a whole bunch of things, going from things like the adoption credit amount to the amount of the unified credit for estate taxes to the amount of the annual gifting limitation. All of those things are potentially impacted because now we have to go back and compute their inflation adjustment using this lower CPI, the chain CPI, for that purpose. Now, there had been speculation. Was the IRS actually going to go back and restate all these numbers, which, by the way, is not going to be a small project, or would they just decide to administratively kind of allow to stretch the law and decide that we're going to use the 18 numbers that we published, and then we'll adjust things later for 19. Well, Harlan Weller, who's an actuary in the Treasury Office of Benefits Tax Counsel, speaking to that group in D.C., essentially let the cat out of the bag. He confirmed that the IRS is going to be issuing new revised numbers, basically, though he could not give a specific time frame for when those numbers will come out. The big takeaway from that is anything that you've been using, let's say, for planning or working with clients, that depends on those 2018 numbers, you need to take those 18 numbers as estimates of where we'll be, and probably estimates, I should say, of the maximum number that will be at, and instead of treating them as absolute. So it's very possible that instead of having your numbers where you think they're going to be, let's say we could actually see theoretically the gifting number drop back from 15,000 maybe to 14,000, so that our annual gifting limitation will now go back to being at a lower rate. And if you'd assume that your client and they wrote a check for $15,000, assuming they would not have to file a gift tax return for 18 if they gave 15,000, and now it turns out that that number drops down, well, the client's going to end up filing a gift tax return and going to burn $1,000 of their unified credit. That's probably not the world's worst disaster, but conceivably, if you were actually planning on and you had a client who really wanted to do this, the good news is usually they don't, and they wanted to make the maximum lifetime gift, and you went back and said, well, it was set to 5.6, we've doubled it, it's 11.2. If they wrote a check for 11.2, consequences there could be a lot more significant if that number does not stay at 11.2, but rather comes down. By the way, that one gets more complicated due to the rounding figures, the fact we doubled it, and there are all kinds of reasons why that will probably be one of the tougher numbers to predict what will come out. But the bottom line is you need to keep your eye out. Anything that you have read for limits for 18, for most tax items, you got to go back and say they might not be what you think, because Congress, in the law, in the Tax Cuts and Jobs Act, changed how those numbers should be computed, and frankly, changed them in a way that normally is not going to be taxpayer friendly. We have some indications now, too, that came out this week. These were comments by Clifford Warren and Brian Rimke at the New York State Bar Association Tax Section Annual Meeting. These comments were earlier in the week. They came out on the 23rd of January. But what they gave us was some indications of what's the IRS's priorities going to be in issuing guidance. Now, Tax Analyst, in an article that's going to be published Monday, contains discussions that say most of the guidance they hope to get out over the next 12 to 18 months. And yes, I did say 18 months, which means, of course, that we're going to be at the end of this year, and there's still going to be guidance on some things we won't have. Be aware of that fact. You're going to be dealing with uncertainty, and you're going to be dealing with uncertainty when we get to the end of 18. So if that bothers you, you're probably in the wrong profession. I'll just tell you that you really need to. Now, maybe it can bother you, but if you think like, no, I can't work like this, you might want to go try something different. There's always skydiving. You could teach that. One of those things. Now, some of the key initial things they've mentioned, we've already seen guidance here. The tax on what's effectively, let's call it the repatriation tax. That's that tax on overseas earnings that have not previously been subjected to U.S. tax. That companies are going to pay that, mostly companies. It can't apply to individuals, but we're going to pay that over a period of time, up to 8 years, because that has to start being paid here very quickly. The IRS has been really moving quickly trying to get that guidance out there. They've also taken care of some crisis issues. You may remember that if somebody buys a partnership interest from a foreign national, and that partnership, had it sold its assets, would have generated effectively connected income for any gain on sale, that you have to withhold 10% of the purchase price. Well, here's the catch. Publicly traded partnerships, which are being sold via brokers, we don't have guidance yet on how this withholding is really going to work. We don't have a whole lot of details about it. The IRS issued a notice right up front that said, until we get further along and we get some guidance out here, we're kind of suspending that. So don't worry about it. So those types of guidance have been the initial ones and what they're concentrating on getting out. After the fires are put out, which is effectively what those are, the next key ones they want to go on first will be the qualified business income deduction. What's qualified business income? What is a specified service business? How does the W-2 and property limitations work? All those things. And also the guidance on the limitation on business interest deductions. Those are the two that they see at this point as the most important guidance areas. Then they'd say following shortly after that, they'll plan to get on to bonus depreciation. One item which they suggested will not have a high priority, so this may very well be on that 18-month list, will be the guidance on the carried interest provision. Remember the carried interest provision where you have to hold where now we got the partnership has to recast the assets as 18-month as not 18 months, I should say, but as 3-year assets for long-term capital gain purposes instead of 1 year if the person received their interest under the carried interest, so they received it for services. Guidance on that area will probably not be out by the end of the year, is what I probably suspect. At least that was the indication given here. Formal priority report has not come out yet. They're working on it. Obviously, you want to keep your eyes on that, but this may give you some idea of where we're going. One other article that came up that I thought was interesting, again at that District of Columbia Bar Taxation Community event, Veena Murthy, who is the legislative counsel for the Joint Committee on Taxation, gave comments. Now, Veena reminded people, everybody's all freaked out about meals and entertainment. And can we claim a deduction? Well, the real question usually comes down to, what type of meals can I claim a deduction for? What happens if like, I hold a company picnic? Are we going to be able to deduct any of those meals, or are they going to be, are they going to be totally disallowed? What happens if I take a client out to lunch? Is that totally disallowed? All of those little issues. So, and then also, since we don't get 2% itemized deductions anymore, does that mean that you can no longer exclude from employees' income if you pay for something for them that had they paid for it, it would have been an employee business expense since it wouldn't have been deductible if they'd paid for it? Do we have to now throw that into income? So Veena took on these issues. First, she reminded everybody, and you all really need to remember this, okay? Before hyperventilating too much, go back to the code. I realize that some of you believe if you look at the code, you'll be struck by lightning. I guarantee you that will not happen. Go to the Internal Revenue Code. Go to section 274E. If you have a tax service, you have access to that code. You have access to 274E. 274E is a list of items that are specifically not considered to be entertainment and therefore are not blocked by the entertainment rule. That includes paying for employee gathering meals. So if you have a meeting with your employees or your employees, you have that company picnic, those costs are not considered entertainment costs. So they're not going to cause you a problem with that. The world's not going to end. You're going to be fine with those issues. Similarly, if you are an employee and you are being reimbursed, or you're a contractor and you're accounting to your customers for meals that you're incurring while, your meals, those meals are going to be fully deductible as long as you account for them to the other party and you've not agreed that you're going to take the hit. So that's not changing. Take a look at E. E is still there. E still overrides the rules in the A section, which is where entertainment is. So, before hyperventilating, go there first. That'll calm you down on a lot of issues. But then Veena said, okay, for the things not in E, how do we do that? She reminds us, she says, helpfully at first, meals are still 50% deductible. But then she goes on to say, and this, according to tax analysts, this is a direct quote. However, meals that are considered entertainment, whatever that means, gotta love that term, are no longer deductible. So the catch here is your meal entertainment? That's not, and it's entertainment and it's not in the E list. That becomes a major problem. Why? 274A very broadly defines entertainment as any activity that is generally considered to be entertainment. Now, I've told people who have taken the courses I've taught on this area that what I did almost immediately was I fired up Google and I just typed in the Google search bar, trying to find information on entertaining clients and customers. So I typed that in. You get a whole series of articles on marketing to your customers. And every one of them had as one of their things of entertainment you should be doing to cultivate your relationship with your customer, that you should take them out to a nice restaurant. You should have a meal with them and just kind of be nice, be there. Yeah, we all know that we'll discuss some business related issues because we're sitting there. But basically, we're there. The goal, as they tell you in this meeting, is to make sure the client has a good time. Now, I did have one participant in my class earlier this week who said, look, no rational person considers having dinner with their accountant to be good time. So, that maybe, I don't know. I doubt CPA firms are going to be able to get by with that one for deducting all their meal expenses. But nevertheless, we'll say that it's probably going to be an issue as to what are meals. And I still stick by my position I've mentioned earlier this week in the courses. Even, it's not been changed by the statement that your clients have to be warned that any meals aside from the meals for employees traveling on business and the meals, the foods type items that are in the list in 274E, any other expenses for meals at risk under this law. Now, we also have to say this kind of funny. If Vina doesn't know what meals that are entertainment means, and she's on the Joint Committee on Taxation, I should say she's not on, she's counsel, legislation counsel for that committee. If she doesn't know what that means, we're all kind of in trouble. But just be aware, be very careful. We're going to have to see how Treasury tries to interpret that. Finally, Vina went on to say, no change was intended in the treatment of working condition fringes and presumably accountable plans. Why people have been concerned about this, let's say that you were paying for, which we all do. We pay for things for employees so they can do their job. Like, you paid for the airline ticket so the employee could travel, to Houston to see a customer. Well, that's technically a working condition fringe. And generally, working condition fringes are items which you can exclude as long as the employee would be able to claim a deduction under 162. Well, now these aren't just, the employee business expenses aren't just 2% items, they're simply disallowed. Some people have been concerned that by that wording, I would now have to throw the cost of that airline ticket into the employee's W-2. Vina said A, those provisions stayed in the law, and B, that was clearly not Congress's intent. Now, hopefully that's enough to allow us to take the position that we don't have to modify our accountable plans. We don't have to modify what we're paying for employees. Otherwise, I think employees are going to want a really nice big raise because the tax costs are going to go way up if we have to charge the employee for everything the employer provides for them. Or if we don't provide it, they get no deduction. So not many good options for them. What we'll probably be able to do is go ahead and continue it. So at this point, at least according to Vina, if it would be deductible, if we still had the 2% limitation, so it would be deductible, would have gone on 2106. And by the way, we never worried about the fact that maybe the employee wouldn't have been able to clear the 2% or wouldn't have itemized, but that wasn't a problem. And I think that's where Vina's going for this. That basically you're going to go ahead and exclude that from the W-2. It's not taxable. Don't go crazy. We don't have a problem here. The IRS has come out with, and this was in Revenue Procedure 2018-10, issued on January 24th, a new Form 1024A for 501c4 organizations who want to receive a determination letter for their status. 501c4 organizations have to notify the IRS they are forming, but they do not have to actually apply for and receive a determination letter. They can do so, though. Previously, they had done so by filing a standard Form 1024, which is used by tax organizations generally. The IRS has decided that this case for the 501c4 is unique and probably, in the view of the IRS, not quite so pressing as those for other 501 organizations. So they have developed a special Form 1024A, that now has to be used by those organizations if they are applying for the status. They want a termination letter status. Again, they don't need one, right? If they are a C4 organization, They just inform the IRS that we're going to be a C4. If you believe you meet all the requirements, you just inform them you're a C4. But, you might still want that letter. So the IRS is going to do it just like any other organization. The new Form 1024A must now be used. That's somewhat of a problem because the last time I checked, it still was only available in draft form. But in theory, you're supposed to use it right now if you're applying. Don't know how Treasury is going to deal with that. It didn't show up yet as final. Presumably in the next day or two, we will get a final version of that form, we'll hope. We won't go for a super long time with having to use a form that only exists in draft form, which says right on the top, don't file this form. So interesting problem. And speaking of interesting problems, let's talk about what maybe one of the most unusual cases I've looked at in quite a while. Sometimes when you're doing these updates, you just need something that's entertaining. Okay. Now, hopefully that entertainment doesn't mean you can't take the course as a whole. Let's assume that that's not going to be a problem. That goes back to the whole issue of you can't take entertainment. But this case, there are some things it teaches us, but in reality, it's just, wow, he did that. This is the case of Plato versus Commissioner. Good news, it's easy to remember this guy's name. Remember the philosopher Plato. You've got him. Plato versus Commissioner. Tax Court Memorandum Decision 2018-7, issued on January the 24th. Plato was going through a divorce with his soon-to-be ex-wife. And he was trying to get the 2007 return filed as a joint return. Mr. Plato prepared that return. Mr. Plato computed there was going to be $46,000 worth of tax due. Mr. Plato, now here's the catch. His signature's on the return now, right? He signed it. He's got the check with the return, the $46,000 check. But now he still needs his wife's signature to file a joint return. So he takes the return to her house on April 15th. Okay, that's not a whole lot of advanced planning, but we'll live with that. He takes the return to her house on April 15th. And rather than give it to her to get her to sign it so he can then go, file it wherever, he leaves it under the doormat. And we're not sure if he left it there just because he didn't want to talk to his soon-to-be ex-wife, which may very well be the case, or if she wasn't there. But if she wasn't there, it seems a little weird to leave it under the doormat when you're on the April 15th date, although we are told later that he had asked her to file for an extension, but never actually confirmed she'd filed for the extension. He also never actually followed up to find out if his wife had sent this return in. Though he might have had a clue because the check never cashed. The IRS eventually looked around for this return. They had no record of receiving it. The check had never been negotiated. And the IRS also had no record of ever receiving an extension. Now, okay, maybe they lost those things. We don't know. That's possible. But we don't really think that's the case because the tax court made clear that he could not prove that the return had ever been filed, which means presumably his ex-wife was not willing to testify that she had got the return, signed it, mailed it, etc. So now we got this problem. So the IRS prepares a substitute for return for Mr. Plato. Mr. Plato, now receiving that, suddenly thinks maybe I should try to figure out if the return was ever filed. Discovers that there's no evidence that the wife filed the return. He prepares a married filing separate return for himself, computes the tax, pays the tax, but now the fight is over. Does he have late filing penalties? Mr. Plato said, well, I tried to file the return. Look, I prepared the return. I signed the return. I even wrote the check out to pay the tax on the return. But then, I left it with my ex-spouse, and I just assumed I'd paid the tax, right? She would sign the return, and she would mail it in. And, hey, I'd also asked her to get me an extension. So, as far as I knew, the return had been filed and or I had an extension. So I never knew anything was wrong until the IRS contacted me and said, hey, here's your substitute for return. The tax court didn't buy that. The tax court found that leaving the return under the doormat of your former spouse, uh, on the last day for filing, and just asking that person to file for an extension, apparently, without following those things up, simply is not reasonable cause. First thing they point out under the Boyle case from the Supreme Court, you can never delegate your responsibility to file a return. So the taxpayer can't say, well, it's not his fault because his ex-wife didn't file the return for him. He had a responsibility on his own to assure that either that joint return was filed or he had to file a separate return. But the one thing he couldn't do was just say, hey, I'm depending on my ex-spouse. And then it said, secondly, you've got to take reasonable steps to assure your return has been filed. I think most of us could agree putting it under your ex-spouse's doormat really isn't a reasonable way to get it filed, especially when you never follow up to see, A, did the spouse find it there? It may still be under that doormat for all we know. Or, and then did the spouse actually mail it in? Understand communications may be difficult in a divorce, but you got to make sure on something like this. Well, as I said, this has been we've been working on tax update. I've been doing update courses. I finished my final update on the Tax Cuts and Jobs Act, at least that I have scheduled for the moment, here on this week. But there still are courses scheduled around the country in various places for Tax Cuts and Jobs Act additional guidance. So you want to check your state society of CPAs for guidance if you've not yet gotten a TCJA course, and really you probably should if you're going to talk with your clients this year. You want to go ahead and check with your state society, see what's available, see what options they have. For those of you here in Arizona who missed my course, because we did that with Arizona, mine was a 4-hour on February the 7th. Pat Garverick of Phoenix Beach is going to be doing an 8-hour version, and it also will be webcast. For those of you who like to come visit live, one key warning for you. As I got ready to broadcast this, there were only 2 seats available. My guess is by the time you hear this, there may not be any seats available in the room. So this may again be uptake by webcast. If you want to do it live, you better stop playing this right now and go try and basically get your way into the live course before those 2 seats are taken, because they'll probably disappear Monday when that happens. Other states, they've got their stuff in there as well. And check with the other guides we're going to have during the year. We're going to have a lot of TCJA things happening all year. So you want to go ahead and make sure that you take a look at what your state societies will be offering and what we're going to be offering here at Kaplan Professional Education, those areas. So, check with your state societies on that. By the way, somebody's going to ask me to clarify this. It's going to have been asked before. Kaplan Professional Education is the organization that basically is the parent organization for the Loscalzo Institute, and also is the organization which Loscalzo was the old accounting and auditing CPE group founded many years ago by the Loscalzos, and which Kaplan had purchased in late 2015. And then Kaplan acquired Nichols Patrick CPE, which did tax work, who I had worked for. So we are now basically all of that, the old Loscalzo and Associates and the old Nichols Patrick CPE group, we're all working together to do CPE now. And this is all part of Kaplan Professional Education, the accounting part of it. Lots of other things Kaplan does. And that's who they are. I've been asked that question, so I'm going to clarify it. Be sure to join us next week. We'll take a look at some more guidance there coming up here, in February. You can catch our daily updates at currentfederaltaxdevelopments.com. We have information there as things happen during the week. I'll post updates on that site. If you have any questions or comments, you can send them to me by email, edzollers@currentfederaltaxdevelopments.com. I do post on Twitter when we have updates come through. If you want to follow that feed, it's at edzollers on Twitter. And I also participate in discussions on a subreddit on Reddit. That's at www.reddit.com/r/taxpros. The Tax Pros group, as I always tell you, Reddit's a wild place, but it's not wild when you have tax pros to talking tax issues. There are areas that are wild, but there are very, very calm areas in Reddit. So as long as you stay put with us here in Tax Pros, you're relatively safe. So if you have any questions too, you can pose them there. That's a nice place to pose them, just because then we can have a public discussion about what's going on. And lots of times you're going to find that information comes from others. If your state society offers a listserv or some sort of thing like Arizona Societies Connect site, That's also not a bad place. It's really interesting what you develop when a whole group of people start commenting on issues. And with that said, be sure to join us next week. We're going to have a lot happening, and I'm sure we're going to have things to talk about. And we'll see you then next week here on Current Federal Tax Developments.